Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. After a rejection of bullish momentum on the S&P 500, a breakdown of important technical structures on the S&P, we saw a rapid cascade of selling here, a capitulation move, almost tagging the June low that we got here. We've clearly broken down short-term bullish structures. We broke down below the 61.8 retracement level from this rally, and we're getting price action that's similar to the type of capitulation move we also got throughout the month of June. But in this video, we are going to talk about the underlying catalyst that's driving this sell-off and whether or not we can actually see signs right now that this should come to an end. And I wanted to start off this video by quickly showing you this chart right here of the nominal Fed funds rate, right, the interest rate of the Federal Reserve against core inflation, which excludes the more volatile components of the CPI, which are food and energy. This is really the inflation of consumer goods. And the chart makes the point that throughout the majority of history, the Fed funds rate has been above the core PCE. So a lot of investors, a lot of economists are of the opinion that the Fed needs to raise rates to levels that are above the core inflation rate in order to get inflation down. So a lot of investors are very concerned right here that inflation is going to continue running hot and that the Fed funds rate is going to need to catch up to perhaps 5, 6, maybe even 7% before we manage to get inflation down back to reasonable levels. Of course, if the federal funds rate were to rise to 6, 7%, that would wreak havoc in stocks. So in this video, we're going to take a look at a few very important charts that are going to put all of this information into additional context. I hope you guys are going to enjoy this one. If you do, don't forget to click on that like button and subscribe to the channel if you haven't already. Now, without further ado, let's get right into it. Okay, so as a quick recap to what has been driving the market, and I've tried to include this in all of our recent videos to make sure that everybody understands the current market environment. The market today, the S&P 500 today, is being driven by yields. And here I've just got the inverse of the 10-year yield that every time has been leading the market lower. And you can see especially more recently with the CPI report and the recent Fed speech, we're seeing the 10-year yield almost go into a parabolic blow off top here, and of course having a pretty negative impact on the market today. So as long as we see this 10-year yield rising, and right here doesn't seem to be showing signs of slowing down, you do have some bearish divergences here on the RSI. You really need to see this roll over to conclude that we are seeing a shift in intermarket dynamics. But you could assume that when the 10-year yield does begin to roll over, that should be a warning signal that a Fed pivot isn't too far ahead. For now, that's not what we're getting here, right? And we're going to talk about that in just a second, but you can see here in 2018, the Fed funds rate continued rising as long as the 10-year was rising. When it broke down, the cycle ended, right? Here in 2006, Fed funds rate was rising with the 10-year, and you can see when the 10-year peaked, the Fed funds cycle ended. Again, here in 2000, right here, the 10-year yield peaked in around January of 2000 and moved lower. That was close to the end of the Fed cycle. They didn't continue raising rates for years after. It was only a few months before they did pivot. And I can go on like this, but in 1994, the 10-year also foresaw the peak in the Fed funds rate, so the Fed pivot. And we know if we add the stock market, and perhaps it's going to be a lot of lines to digest in one go, but you can see every moment I've put a vertical line here, you can see how the stock market behaves. Here, 2000, it might not look like it actually led to any gains, but you can see it did lead to a rally between January and August of 2000. So that was pretty decent in terms of the magnitude of the move. That was around a 9-month rally here. And then the headwinds from the tech bust really took over and took the market much lower. But you can see here in 2006, again, Fed pivot was a net positive. And again here in 2019, Fed pivot was clearly good for the market. You know, this is nothing new. Everyone knows that a Fed pivot would be good for the market. But I think it's important to reiterate the point that as long as yields are rising, it doesn't tell us that a Fed pivot is around the corner. In fact, quite the opposite. So this is why equities are very concerned about what's going on in the bond market. We're just not seeing that roll over just yet. Now, I do have a few more charts to show you here, and we're going to add gasoline futures on top of yields. And you can see right here the close relationship that we've had since 2020. So for the last 2 years, we've had this magnificent intermarket relationship between gasoline futures, so you can say oil, and the 10-year yield, both trading very much in line with one another. And you can see even moments where you had divergence, so one going in the opposite direction to the other, you eventually saw them snap back to each other. Another example of that was right here in May of 2022, right there. So you saw yields moving down, so that was positive for the market in the month of May. But gasoline was telling you, nope, we're heading higher, and that led to that move that we saw in June, and where the market capitulated in a big way right here. Now, of course, let's address the elephant in the room. What happened here, right? That's a big question right there. Massive move up in yields, and yet gasoline is moving down lower, breaking in a big way this relationship that we've had since 2020. Why is this happening? Yields are not in agreement with oil. Should we expect that to revert? Should we expect yields to move back down to reality? Or perhaps yields are right, and the bond market is telling us that gasoline futures actually have a lot more upside to go, and that the inflation story is not behind us. Those are the two ways that you can think about this disconnect. There's also, of course, the argument that the Fed is driving a lot of this move up, right? The Fed said that they would raise rates higher and keep them higher even if inflation comes down for a while, to not repeat the mistakes of the 1970s. And so perhaps that's what the bond market is currently pricing in, that the Fed is going to remain very aggressive even though we are seeing clear signs of disinflation, because gasoline prices have the biggest impact on CPI, and they're also a measure of supply and demand, right? It's telling us that supply concerns are easing and that demand is also becoming a lot more in line with that supply, which is by itself disinflationary. So perhaps it's the Fed, but we can't predict what the Fed is going to do. We can't try and guess what they're going to say next, or what their opinion of the macro environment is going to be 1 or 2 months from now. That's impossible. If you're trying to predict what the Fed is going to say, at one point you're going to get hurt really bad. And let me just remind you, in late 2020, Jerome Powell clearly stated that he wasn't even thinking about raising interest rates. And here he is talking about a 4% interest rate and going much higher if needed. The point is that the Fed can change opinion on a dime if the data changes. We have to be aware of that, and that's our strategy. That's how we view macro. We're not mind readers, and so we try and look for the signs of the actual macro dynamics shifting as opposed to guessing what the Fed is going to do. Of course, that's just our way of operating. There's plenty of ways to make money in the market. But so that brings us back to our big question: which way is this relationship going to revert? And let me just give you an example of a moment where yields reverted to the downside and caught up with oil. You can see right here, and I think we discussed this a couple of videos ago, but I'll go ahead and show you guys anyway. You can see here oil peaked right there in October of 2018 and saw a major move down here all the way to November of 2018. And so you really had a month and a half where oil was moving down while yields were, staying pretty elevated. Here you can see the disconnect really began right here on the 17th of August of 2022, and we're now a month later. So let's try and figure that out. If you are so far enjoying this video, don't forget to smash that like button. It really does make the effort and the time that I put into making these videos worthwhile. These videos really do take a long time to prepare in terms of organizing them and making sure they're educational, understandable for everyone, and actually actionable. So if you want to help Game of Trades out, make sure to smash that like button as hard as you can. So let's rewind a little bit to June 6th, to this article where we really started to talk about disinflation having a big impact on the market and being driven by oil. You can see here oil prices were overextended by multiple orders of magnitude here in June with the trailing 23-month change in the price of motor fuel. So gasoline prices, that orange line here on the 6th of June being extremely overextended. And you can see that did play out for quite a nice correction. When you have such an overextension in the price of something, it can be dangerous to bet against it because of the momentum. But on the other hand, the odds are that if you're right and you're able to take advantage of that downside on oil, it's going to be a very successful call. In this case, we got the direction and the timing perfectly right, but of course that definitely does not always happen. But now is oil actually going to continue moving down? So we know this was basically a trade where oil was overextended and it needed to come down. Now the question is that trend going to continue, even intensify, or is oil going to rise back up again and yields are actually going to be right, and that's going to wreak havoc in the market? That would be devastating. I'll give you a hint very quickly, but our 6 to 12 month price target on oil on gameoftrades.net is still quite a bit lower than current levels. Right, we're trading at $81 right now. We're still aiming lower based on our research. We're going to take a look at that in just a second. But ultimately, the way we're thinking about this right now, and you can leave a comment down below to tell us what you think about our thought process, but a large part of what drove oil in the first place throughout 2021 were supply concerns, right? Supply shock. And you can see that in this chart right here. This is the gray bars right there are contributions from supply shocks, and you can see lots of supply concerns throughout 2021 and 2022. We had a similar type of dynamic towards the end of 2007. But if we look at history, since 1871, we know that the biggest driver of oil over the long run is demand. It's not supply. You can have some temporary supply shocks, right? And in the 70s, you had the oil shock, but those are generally exceptions. So if you're looking to really understand what's going to drive oil, you need to look at demand, not supply. And from our understanding, the economy is only going to weaken from here, right? Rates have been rising. PMIs, which have a massive influence on oil, they're going to head lower. So you're going to have this situation where perhaps supply concerns are going to be coming down, but most importantly, demand is going to be coming down. So that's how we're thinking about this, and these convictions, including how we're thinking about this tactical setup here, these convictions will be reflected in the model portfolio that we'll be publishing on our website next week, and of course have access to all our articles, our extensive research, where we think the opportunities are in the market, whether that's in the stock market, the bond market, cryptocurrencies, precious metals, opportunities around the world, commodities, and of course our trading watch list that organizes all our ideas, all our convictions into one place. So if you want to check that out, grab yourself the free trial. There's really very little reason not to. It's in my opinion, the amount of effort that we're putting into providing the highest quality research for individual investors is unparalleled. You can test it out for free for a full week and see how you like it. So coming back to that question, on the 10-year, it looks like it's going parabolic here. That's very painful both for anybody who's holding treasury bonds right now, but also for anybody who's holding stocks, because rising yields here are putting a lot of pressure on equities. But ultimately, underneath the surface, it doesn't seem like intermarket dynamics are supporting this move, and it doesn't seem like the underlying macro is supporting this move either. Short-term momentum is bearish. It's to the downside. Short-term technicals are bearish. They're pointing down. But on the other hand, we are oversold on the market. We have an oversold RSI reading, and we've got the breadth that's yet again at capitulation levels that we've only seen a handful of times throughout the past 15 years, only occurring at major market bottoms. This is what capitulation looks like. Ladies and gentlemen, it's a very difficult environment to understand. At the same time, it gives you the most attractive long-term buying opportunities in history. And at the same time, it is when the market can cover a lot of ground very, very quickly in a short amount of time, and is incredibly risky for short-term traders, especially short-term traders that are on leverage. For me, that sounds like a great trade-off. We're going to talk about this in more detail probably in the next YouTube video, depending on how much more capitulation we get I hope you guys enjoyed this episode. If you did, don't forget to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.